There are over 8,000 stocks trading in the US markets every single day. Most retail investors pick maybe 5. What if an AI could screen all of them in under a second? Today, I'm pulling back the curtain on how AI actually picks stocks. No hype. Just logic. Let's be honest, most of us have been there. You spend hours reading analyst reports, you buy in, and the stock drops the next day. You follow a financial influencer's hot tip and get burned. You go with your gut, sometimes it works, often it doesn't. The problem isn't you. It's the amount of data a human brain can process. Every day, thousands of earnings reports, news articles, SEC filings, and price signals are generated. No human can read all of that. But AI can. Here's how AI quantitative stock selection works in 3 steps. Step 1: Multi-factor scoring. The AI evaluates stocks across dozens of dimensions simultaneously: price-to-earnings ratio, revenue growth, profit margins, return on equity, institutional money flow. Each factor gets a weight. The AI combines them into one composite score. A human analyst might track 5 metrics. An AI can track 50 in milliseconds. Step 2: Sentiment and news analysis. AI reads financial news, earnings call transcripts, and even social media and assigns a sentiment score: bullish, bearish, or neutral. When sentiment hits an extreme, like maximum fear or maximum greed, that's often a contrarian signal. AI catches it before most people even notice. Step 3: Historical backtesting. Before the AI recommends anything, it tests the strategy against 5 years of real market data. What was the annual return? What was the worst drawdown? How often did it win? This isn't gut feeling. This is strategy validated by data. Let me show you a simple example. I built a basic multi-factor model with 3 conditions: P/E ratio at least 30% below the industry average. Revenue growth above 20% year over year. Positive net institutional inflow for 5 consecutive days. I backtested this on US and Asian market data from 2020 to 2024. Results: average annual return, plus 22%. Maximum drawdown, minus 15%. Win rate, 58%. Sharpe Ratio, 1.48. Now, this is a teaching model, not financial advice. But the point stands: a rules-based, data-driven approach consistently outperforms random stock picking. Okay, I have to be straight with you because this is important. Risk number 1: AI cannot predict black swan events. Policy shocks, geopolitical crises, surprise earnings misses, no model can see those coming. Risk number 2: overfitting. A backtest that looks perfect might be fooling itself. If you torture historical data long enough, any strategy will look great in hindsight. In live markets? A different story. Risk number 3: markets change. What works in a bull market often fails in a bear market. AI models need to be updated and retrained regularly. AI is a powerful tool, not a crystal ball. It removes emotion from your process. But it doesn't remove risk. That's the core logic behind AI quantitative stock picking. If you want to see me actually code one of these models from scratch, line by line, real data, real results, then hit subscribe and turn on notifications. That's the next video. See you there.